Hi, Meb. Welcome to Face.
Hey guys, good morning. How do you do?
Good
Thank you
morning.
for getting up with the rooster.
Sure, no problem.
Meb's on the West Coast too, so we're watching a beautiful sunrise here in California, COVID capital of the world. So, Meb, really nice to meet you. I went over your website. Do you want to share your screen, or would you prefer that I share your PowerPoint? Up to you.
Either way, you're probably at the controls, so maybe easier if you did it.
Okay, I'll share my screen. Okay. So, why don't we start off with about Meb Faber, and there you are, buddy, and welcome to the Southern California lifestyle. How long have you been here?
Well, I'm actually dialing in from Colorado.
Oh, okay.
Once they closed the beaches again,
Yeah.
I had to I had to get out of town. We got a lot of family here in the mountains, so
Oh, nice.
spending a few weeks on a road trip across the U.S. like I think a lot of other people. I've been on the West Coast since early 2000s. Was up originally in NorCal, Tahoe, and moved down to Los Angeles, Manhattan Beach
Yeah.
for a year to try it out. That would have been in about 2004, 2005, and that 1 year has turned into 15.
Yeah. Is
So
this
it's
a
it's
picture
been a
of
great
you on the
place.
beach that I'm showing right here?
It's not, but it's not too
Okay.
far away.
All right. Well,
It's despite the taxes and everything else,
let
there's a
me
reason
let
why
me
so many
ask you
people
this.
want to
I
live
I
there.
have an expression that great surfers don't try and catch every wave. Like great traders, great surfers don't try and catch every wave. You see some parallels in surfing to being in the markets?
I see a lot of parallels, but mine comes from kind of the opposite angle because by no means am I a great surfer. Growing up in Colorado and North Carolina, I'm a fairly terrible surfer. I'm a good skier. I'm a terrible surfer. So for me, the parallel is more the humbling nature of it, where
Yes.
just when you think you're hot stuff, the markets have a way of taking you out behind the woodshed. And the same thing is true about the ocean, of course, where there's no more humbling force than that of Mother Nature. So
Yeah,
I have a slightly different
purling on a
angle.
beach break. I tried to learn at 40 when I moved out here. So,
Yeah.
yeah, I did. The wave. All I'd have is air under me when the wave was breaking. Anyway, I gave it up. So, I want to, just start moving through your PowerPoint, and it looks like it's pretty much based upon how now brown cow after COVID and the crash, and here we are. So you could see my screen, right, Meb?
Yeah.
Okay, so let's go to the next slide.
Sure. And if
Go
you
ahead.
if you could if there's any way to make the slides a little bigger on presenter view or anything, that may make it easier for people to see it. But if not, it's fine.
Okay.
Um, so where to begin? As people look around the world here in mid 2020, it's been the dawn of a new decade, which is somewhat amazing because we're only 6 months in, and it feels like
A decade.
an entire decade has passed already.
Yeah.
But we had remarked kind of at the end of last year that subjectively speaking, decades often have a way of marking large turning points in society, but also markets. If you look back in history, many of us, the older crowd or the historians can recall plenty of decade ends where markets had pretty big inflection points. Obviously the people can remember the financial crash of global financial crisis of 10 years ago. Prior to that, of course, the internet bubble. When I first moved to San Francisco, right at the very peak of it. And then 10 years prior to that was the biggest stock bubble we've ever seen, which was Japan, and on and on. And so I jokingly said at the end of the year, I wonder what 2020 decade will have in store for us, what will mark this. And it only took about 1 month in before we started to figure that out. But a lot of the forces at play, and I'm talking a little longer term here, have been in play for a while. And, the thing that most people like to start with, which is what kind of I'm bringing up here, is what's near and dear to most of us here in the US is stocks. And stocks ended the decade, we said, December 31st, have a glass of champagne, have a beer, toast your loved ones, pat yourself on the back, because it was an exceptional decade for stocks. And what we said with that cartoon graphic that you saw was that the challenge is that the good often precedes the bad, to say it extremely technical,
Yin yang.
and vice versa. The good times set the stage for more somber times, and on the opposite side, nothing really lasts forever in markets. And so it was one of the best performing decades, but that meant by the end of the decade, stocks had gotten pretty expensive. They'd started the decade cheap and ended pretty expensive.
Is that your Uber driver there looking in the rear view?
Exactly.
Okay.
So, this graphic, I think, is meant to be humorous, but a lot of people in markets, one of the biggest mistakes is they try to extrapolate, what's happened in the past to the future in a way that, I think can be dangerous. And so, for those that are familiar with my work and our company, we have two main pillars that we spend a lot of time that build a foundation. On one side, it's momentum and trend and sort of price-based variables, and on the others, it's fundamentals like value. And so, if you were to put stock valuations into context, and this goes back over 100 years, we didn't invent this metric. Professor Bob Schiller wrote about in the 90s, but then it's based on stuff from Ben Graham writing 100 years ago about taking price earnings ratios for individual security. Instead of doing 1 year, Ben Graham talked about 5 to 7. Schiller said, let's round it out to 10. And in this case, applied it to the entire stock market and found that, lo and behold, the average valuation was around 16, 17. But there was times when it got to 20, 30, 40. The dot-com bubble was the highest it's ever been at 45. There's times it's down around 5. So it's been somewhat this crazy indicator, but the high ratings usually preceded low returns, low ratings preceded high returns. And so where are we now? We're at a value of about 30. It peaked maybe about a year ago at around 33, but this year has seen a lot of movement both down and back up. But again, a decade ago it was cheap. So
okay,
if you move to the next slide, let's take a drive. We passed Vegas on the way to Colorado. It was crazy. It was kind of a ghost town on the Strip, nothing open. But if you were to go to Vegas when it was open and play blackjack and sat down at a table and you're a tourist, you're sitting next to a tourist and, he's got 19 and the dealer has 6. That's a pretty good hand. But he says, hit me. And you're like, what are you doing? That's so crazy. I can't believe it. And he says, shut up. You don't know what you're talking about. And he gets a 2, right? Makes 21. You say, well, look, it worked out, but it was not a sound decision in the beginning. And that's kind of how you need to think about markets, is that you can come up with a fairly decent approximation. And this table is not mine. It's actually John Bogle's. He wrote a formula in the 90s, founder of Vanguard, right?
Yeah.
Where he said,
he was really one of the best guys that, I saw him, remain calm during major drawdowns in the market and was, Mr. Long-Term. Wouldn't you say?
He's probably done more for individual investors and institutions too than almost anyone on the planet. And RIP, John passed away last year. And by the way, I have a tendency to just blab on, so interrupt me at any point.
Okay, man.
So
I'm known to interrupt. See?
Good. So he came up with this formula and he said, look, and he would never frame it as forecasting, but rather just to frame expectations, where he said, you can come up with a pretty good idea what stocks will do the next 10 years by three variables: starting dividend yield, then your dividend or earnings growth. Usually they tend to be roughly the same. And lastly, change in valuation. And he's like, that explains all the stock returns for the past 100 years or so. And it's incredibly accurate if you plug those numbers in. Now, of course, the problem is we don't know what earnings growth and valuations will be 10 years hence. But if you just plug in the historical for earnings yield earnings growth and dividend growth, then you can run through the scenarios on what happens with valuation. And so right now we got this 2% dividend yield, which historically is pretty low. There's reasons for that. We could get into probably if we had
central planning.
2, 3, 4, 5 hours, but we'll just move on.
Okay.
We know what the starting valuation is today. It's around 30. And the question is, 10 years from now, what will valuation be? Will it be flat? Will it be up? And if you're at blackjack table, the most likely scenario is that valuations drift back down to, quote, sort of normal ranges. Now, normal historically, I said down around 17, but if you have low inflation like we do now, you mentioned central banks, people pay a higher multiple. So call it low 20s.
Why don't we talk about that a little bit, Meb? The low inflation. You have headlines. People buy headlines today, sell newspapers tomorrow. But you have headlines in the precious metal complex. Grains are starting to look good. Industrial metals are looking good. Is it possible that what we're seeing and what we see in the grocery store since COVID and the supply chain issues, that we're going to have to factor in more inflation than the market is currently expecting, in your view?
Well, I love that, because you just mentioned a few areas that have been left for dead for the past decade. Commodities in general.
I think the ratio's at a historic low. Stocks.
Yeah, they had a really tough decade, and we consistently and have for a long time, mentioned that there's really three main buckets that all investors need to consider in a balanced portfolio. It's global stocks, global bonds, and global real assets, in which we include real estate and commodities. And as you mentioned, they've started to perk up, first with gold, now with silver this morning. I have my family comes from a long line of farmers. And so it's very painful for you to mention the ag prices, because I'm very well aware that the prices of wheat and corn and how they've been.
But when I started, Meb, these are good prices. I mean, when I was started in the late 70s, you had $2 a bushel corn, you had $3 wheat, you had $5 beans. I mean, they've all doubled. And these are still not good prices for farmers. I have to think it's because of the cost of production, because prices, at least in nominal terms, have increased over the last 20, 30 years. I mean, remember the old mantra, beans in the teens? We even accomplished that several years ago.
I think the inflation does play, a factor, and it is the big long-term risk for most portfolios, which is why you want a lot of the elements that, kind of we talk about that help to protect against that. Being a market analyst and historian, you have to prepare for any environment. And we wrote about this actually back in March about coronavirus, which we can get into. But in the inflationary concept, you also have to at least consider the possibility of deflation. I mean, we live in a world where most sovereign bonds around the world actually trade at negative values. And it's hard to conceptualize and believe that's possible in the United States, but we're down around 60 basis points on the 10-year, and it's not that far away. They didn't teach that in the textbooks when I was growing up.
No.
It's at least a possibility that I think people have to consider. And so,
were you a little surprised, since you brought up the 10-year, Meb, that with the huge recovery we had in S&Ps from 2,200 to 3,200, that we didn't get any pop, hardly at all, in yields during that whole time frame?
So I like to say I'm always surprised and never surprised. I mean, every day with markets, it makes it our job interesting. But the number one thing that we tell people that they have to do if they want to become serious investors and traders is become a student of history, and to realize that crazy stuff happens all the time, and at least be able to at least consider all the possibilities, how rare or crazy, like oil futures trading at negative values, like
never would have imagined.
Right, like a pandemic occurring. And so one last comment on that table, and then we'll move on, is that so you at least have to consider the possibilities. And so, could valuations trade back down to 5 in U.S. stocks? That's happened before. Yes. Could they trade up to 45? That's what we saw in the internet bubble. Yes. The most likely scenario is they drift back down to average for stocks, which means next 10 years, stocks should have low single-digit returns. That's not exciting. It's not, it's saying they have to go down 10% a year and they have to crash, but it just means they're going to be more muted. The problem is most investors, survey after survey, expect 10% a year in returns. So they're getting set up to be disappointed. And it's a kind of
pension funds
doctor would say,
7.
Take your medicine.
Yeah, pension funds need 7, don't they, Meb? That's going to be a problem for them, isn't it?
We wrote a paper about this years ago called Pension Funds Investing, Fingers Crossed and Eyes Closed. And, most of them know darn well that in a world where, let's say U.S. stocks, I'm going to be generous, let's say they're going to return 4% for the next decade. And bonds, what you're going to get with bonds. Let's be super duper 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 generous and call it 2%. Which of course is not where they are, but
right.
You can't even add 4 and 2% together to get 7,
right?
Because that's not how it works either. There's no combination of those two assets, and so the pension funds, have started to move into other ideas that I think are really going to set them up for trouble. That could be one of the largest societal issues over the next decade. I think will be a lot of the pension problems, but
anyway, I wanted to brush on it, and just so people know that there are other things besides COVID out there,
and so, but I think it's important when you talk about expectations, because if you say, look, my base case is stocks at 4, bonds at 2, I need to adjust my expectations and lifestyle to account for that. Save more, spend less. That's good advice for almost any time. Or you can also start to say, are there other assets that will be complementary or do better than 4 and 2? And that kind of leads to the next slide or two, which is most Americans.
The globe is a big place.
Most Americans don't have a passport. I think it's right around half.
Yeah.
A lot of people.
Well, we can't use them now anyway.
I know.
Go ahead.
Most people think in terms of their own worldview, and like this chart says, that if you were to buy the global stock market, the U.S. this used to be half, now it's 58%, but this waxes and wanes over time. Like I mentioned, in the 80s, Japan was the world's largest stock market. But if you were just to follow our prior mentioned Jack Bogle, if you were to go out and buy the world, this is what it looks like. But if you look at the next slide, the problem is nobody does that. And what everyone does is something really stupid, which, as we call this home country bias, where they put all their money into their own stock market. And it's not as bad in the US because we're the biggest, but our friends in Italy, Australia, Japan, all the way down, every single country does it, where they put like 50, 60, 70, 80%. US, the average is 80%, by the way.
They buy what they know.
You buy what they know because it feels comfortable. It's a false sense of security. And it ends up being a really bad idea because you have this massive, massive concentration. And that the next chart's actually from Vanguard, showing that people put all their money. Now, it's been look, pat yourself on the back if you've done it in the US the past 10 years. God bless you. You've crushed it. Ask any other country in the world. Ask our friends in Brazil, Greece, Russia, all the way down. Was it smart to put all your money in one stock market? And they would say, absolutely not. That's crazy. So having a diversified global view, I think is very thoughtful.
Well, we have a recent development here. I mean, it's kind of been turning, like, it takes time to turn a battleship around. But there's been some pretty good weakness in the dollar and euro making new highs. Is that part of your thesis for being an emerging
Man,
markets?
now we're on to currencies.
Yeah.
I know is something y'all talk about, and on the long time horizon, currencies tend to balance themselves out for inflation, and on a real basis are fairly stable over time. But over the time frames of 1, 2, 3, 4 years, they can obviously go up, down 50%. So I have kind of two comments. One is that, in equities, I'm agnostic. If you've been listening long enough to this podcast, or webinar, that I have very strongly held opinions about some things, and about some things, I don't. And currencies,
you don't.
If you're going to do stocks, you can either hedge or not. I don't really care, but you need to have some sort of approach. I think flipping back and forth, unless you have a trading system or a style, I don't care if it's valuation or trend or whatever it may be, as long as you stay consistent. But yes, it does seem like after a long period of strength that the US dollar is starting to show some cracks, and we'll see if that develops anymore. I think currency hedging makes a lot more sense if you're a bond investor, because it introduces a lot of volatility that bonds don't necessarily have. But again, these are not strongly held beliefs in either case. If you were to tell me do one or the other, I'd say currencies are really confusing for investors, by the way. I think it's hard for investors to think in terms of
I'm
currencies,
confused
particularly
right
in the US.
now. Yeah.
What's that?
So I can relate to confusion. So, okay, so we're looking at this, and you're a believer in diversifying around the globe. Any areas that you like?
Yeah. So let's go down a couple of slides. There's a chart of valuations, and this one to me, yeah. And we wrote a piece recently, and I've been banging this drum for a couple of years. Is that I said it's the biggest valuation spread in 40 years, and this chart is a demonstration of the former CAPE ratio we discussed, so 10-year price earnings ratio on the U.S. stock market. That's the blue,
right? And
then the red is the world outside the U.S. And one of the biggest arguments, we hear a lot of arguments, by the way, about why you should put all your money in U.S. stocks. People say that there's the familiarity, there's the rule of law and stable politics, which I always laugh at. If you talk to anyone outside the U.S., it's always a funny conversation. But one is people say, no, U.S. stocks deserve to have a higher valuation. They always have. Why would I go invest in these other countries? They deserve to be lower valuation. And to which I usually ask my friends, I say, okay, if the U.S. has a higher valuation, so the U.S. is around 30, the rest of the world's probably half of that. I say, what's the historical premium? And they come up with a number, and I say, well, because the answer to the historical premium is zero. For the last, 40 plus years, the valuation of both U.S. and foreign markets, the CAPE ratio has been 22. And it's sometimes the U.S. is more expensive. So you can see here that now in the late 90s, but sometimes it's cheaper. For the entire 80s, when we mentioned that Japan was booming and the U.S. was struggling, Japan got to the highest valuation we've ever seen for a stock market. It hit a CAPE ratio of almost 100, which is incredible to think about. With the U.S. is at 30 now, it means it needs to triple to get to that.
But even back then, we had a mean reversion back to equality after the Nikkei bubble popped. Yeah. And so is your narrative here that there's some type of mean reversion? How do we get there with U.S. stocks being flat to weak and emerging markets outperforming during this time frame where they may meet and merge again? These valuations.
So there's a number of different pathways, and if you were to ask me at the beginning of 2020, I certainly wouldn't have outlined the one that we've taken this year to date. If you go back in history and put stock markets into a quadrant of, are they cheap? Are they expensive? Are they in a downtrend or are they in an uptrend? And you can use any trend indicator, but like a long-term moving average. Historically, the best performing box you want to be in is cheap uptrend. The second best performing box, and the worst, is expensive downtrend. And so that makes sense. The second best performing box is expensive uptrend, though, which is where we are now. But when that flips to expensive downtrend is usually when there's a lot of pain. So there's a million different future pathways. The U.S. doesn't have to crash. It could simply do 4% a year while foreign developed and emerging does 10, for a decade. That has a way of rectifying the valuation. But this is a summary. U.S. is around 30, foreign developed is and this is average for countries, not market cap weighted. Foreign developed is totally reasonable. These numbers have obviously bounced around all over the place this year. Foreign emerging, we're on record thinking is pretty screaming cheap. And the cheapest bucket, which is if you look at 45 developed and emerging market countries, and we track all these valuation ratios. And by the way, listeners that are probably pulling their hair out about CAPE ratio, valuation metric doesn't matter at all. You could use dividends, you could use earnings. In the US, the value line median PE is the highest it's ever been. They all should say the same thing when they're at extremes. And valuation is a very blunt tool. If you're doing it to 2 decimal points, you're doing it wrong. And also at the time horizon, it's a decade. It's not next month, quarter, even year, but it plays out over the next decade. So the cheapest bucket is down around 10. So you say, look, these countries may very well
give us a few countries that would be in the cheapest.
All right, let's see. Let's test all of our listeners' geography skills, and it's early for me, so I may not be able to even identify all these. No, so Argentina's funny because Argentina kind of jumps in and out of developed, emerging, frontier status depending on their crisis.
Depending on always if they're in default again or not.
Yeah, that's too painful for me to even think about. We've owned Argentine bonds at some points over the years, but so look, this is the challenge: is that value investing often means you buy simply what's down the most already. So if you do a correlation of buying the cheapest stuff, the P and the PE is what drives it. It's not the earnings usually. It's just that the price has already gone down 40, 60, 80, 90% is why the PE is so cheap. And then usually when the PE is expensive, it's simply because the price has gone up, like the US. So these 5 countries, let's see. I think it's Czech Republic, Poland, Spain, Russia, in Colombia, which is like a who's who of places no one ever wants to invest. But in Q1, by the way, many countries got into single digit PE ratios. Some of these are at like 5, 6, 7. And so, are there economies thrumming, is everything going well? No. I mean, in many of these, there's some were going through their own Great Depressions. Unemployment is double ours, really struggling, but how much of that margin of safety is built in? And so with valuation historically, it's not just about buying the cheap stuff. It's also about avoiding the really expensive. The good news is most of the world, we have the US as being the second most expensive market. Most of the world's not crazy expensive. And the US isn't even that crazy expensive. It's just expensive. And so anyway, these countries, I think, have a lot of opportunity. When the value and momentum start to align, that's really when you see the potential explosive returns. And that's kind of been back and forth over the past handful of years. We'll see when that ever happens. But if you had to split it out by development status, emerging value would certainly be our pick. Now, one last comment. Each market, by the way, is not just one market. If you look at the US, you can break it up by size, large cap, small cap. You can break it up by valuation. Sometimes they look different. Sometimes they look similar. Q1, small caps, and particularly small cap value, got absolutely destroyed. It was down 50% at one point. Yeah. Listeners that own those stocks can probably relate. So the spread between the large cap growth, the Teslas, the Facebooks, the Amazons, and the small cap value blew out this year. So if you're going to do the US, we say, look into sort of small cap value. But if you're going to do global, think certainly beyond our shores.
Okay, let me ask you this, Meb. We're only about, what, 3, 4 months away from a presidential election and U.S. elections in general. Did that fit into your narrative, and the market seeing it as things I've read is that, market's not going to be that upset if there's a Joe Biden presidency as long as the Senate doesn't flip. Does it work into your analysis, and are there ever times when it's okay to be in cash and not always fully invested?
Oh, you got a bunch in there. Okay, so let's unpack each one at a time. I'm a
Okay.
quant, and I think it's important. I don't care if most investors are quants or they're discretionary, but it's always important to at least have a plan. And we encourage all of our investors. We have over 40,000. We say, look, write down your plan, just like as if you're tackling an exercise regime. Share it with your significant other, your children, or your partner, or your neighbor, whatever, to keep you accountable. Because if you don't have a plan and you go open the refrigerator at midnight, you're probably going to take the ice cream out. If you don't have a plan in markets and you wake up think back to March, when markets were down 8%, the futures were hitting limits every which way, you're probably going to do something stupid. So having a plan is probably one of the most important things, whatever that plan may be. You may be, look, I'm a dividend guy, I'm a 60-40, I'm a trend follower, I'm a technical sport, whatever. It doesn't even matter.
Many ways to skin a cat, right?
Yeah, as long as you have some sort of foundation from which to not shoot yourself in the foot, which is what we see so much behaviorally speaking with investors. And we still talk to investors that got out of stocks in 2009 and never bought back in. So having cash, by the way, totally acceptable investment and asset class. Now, whether that's 5% or 50, we don't think it really matters. We actually did an article. We did a big series this year called the Get Rich Portfolio, the Stay Rich Portfolio, investing in a time of coronavirus and how I invest my money, because I disclose very transparently what I do with my own money. But in that, the Stay Rich Portfolio, it talked about the role of cash and its importance. It gives you optionality, it gives you sleep at night. But over long-term horizons, because of going back to what you mentioned in the beginning of inflation, you have to have some growth type of assets in there, because cash on a real basis after inflation is just as risky as a lot of other investments. People just don't see it because it's a slow bleed. So a safer portfolio is actually blending cash with stocks and real assets too. So we always tell people cash is a totally acceptable decision. Now, going back to elections, this is where you grab your beer or coffee. It's
you don't
enough.
invest around it. It's cocktail chatter. Huh?
So, but it's fun and it's interesting. And I'll give you 2 points. One, as we said, back to the prior election, I said that the outcome of this election is totally meaningless. This won't be popular. Markets will do what they may. And I said, however, you can forecast the election with about 80% certainty, and that's based on the stock market. And is the market up? And you can use, I think, a couple different variables, but one, there's a white paper that showed the 3 months going into the election. So right now, starting today, essentially until election time, if the market's up, the incumbent party wins like 85% of the time.
Right.
And if the market's down, they lose. And so that correctly, again, predicted the last election. And so you better believe that the powers in office are going to want to see the stock market up over the next few months to the extent that they can explain that narrative. Now, whether or not the impact of the election impacts stocks the way that most people believe, markets tend to be forward looking. And when the election happened last time, I was tweeting because the markets were crashing. If you recall, after Trump started winning, the futures were down big that night.
Limit down till Carl Icahn went home to buy. Yeah.
Zero people would have predicted for the first time in history that the stock market went up every single month in a calendar year. That's never happened before. It happened after the last election. I think the market was up like something like 16 months in a row. It was a record. So again, we always joke that when a lot of advisors write letters, they write advisors like, it's okay, clients, this has happened before when something crazy happens in markets. But we always say what they should be writing, because something will surprise us, is, okay, clients, this has never happened before. So we'll always be surprised. Now, the betting markets are favoring Biden right now. Trump, I think, is at plus 150 versus Biden, but who knows? I think in general, the party in power, it's more cocktail chatter than impact on investments.
Okay.
But I don't know.
It was very interesting having a conversation with you, and your demeanor, Meb. Your DNA was suited for this. You have a very calm demeanor. Accomplished. The best way for listeners, viewers to follow you. You do anything for the retail trader, or you're mainly just dealing with institutional clients?
No, so my day job, and thank you for having me today. This has been so much fun. We need like 2 or 3 more hours. My day job is I'm the founder and CIO of a asset management company called Cambria. We manage 11 ETFs, and they are mostly quantitative based. It's everything from asset allocation funds to very specific niche products. Our largest is actually a tail risk fund, but things like global value and sovereign bonds, we do a little bit of all of it. And the big difference between us, I think, in a lot of traditional shops is I put all my money into our funds. The average mutual fund manager actually has nothing invested in his own fund, which is a really unfortunate, sorry state of affairs. And so Cambria Investments, which is where you are, by the way, you can go download most of our books for free. So go check those out. I would start with Global Asset Allocation if you're new to us. But you mentioned Carl Icahn. He's on one of the covers for one of our books. But those are all free. The Invest with the House. Yeah, but GAA is the one I would start with, I think.
Okay. I really want to thank you.
But yeah, we have over 40,000 investors, so it's not just institutions; it's people all over the world.
Thanks for making time for us, Meb. Really glad that I reached out to you, and like it or not, you're now my trading warrior brother.
Yeah, and I look forward when the world goes back to normal, hanging out in person in California or wherever we may find ourselves.
Yeah, really nice meeting you, and thanks for edifying F.A.C.E today, Meb. Really appreciate it. Good hunting to you, buddy.
Cheers. Bye-bye.
Okay, everyone, that's a wrap. You can find Meb on Twitter and Cambria Investments. And I think that if, you have your own pension and you're managing your own money, that could be a great resource for you in the markets. Think international. And that'll be a wrap. That will be a wrap for us. So I'm just looking to close it here. Hope everyone has a good day. Congratulations, all you precious metal bulls. Don't forget, take a little something off the table. And I'll see everyone tomorrow. Adios. Okay, you're very welcome, guys. I'm glad you enjoyed Meb. We'll see you tomorrow, investing.com Thursday. You're very welcome. You guys have a good day. Adios.